because of this back and forth of what some people are calling a little soap opera here. Fitch Investors is warning that it could be cutting the USA's AAA credit rating as this shutdown continues. Now, they're arguing that we're going to be hitting a debt ceiling and it would hamper the budget process, as if there is a process going on. But nevertheless, that would be big news if it were to come to pass. To Moody's Capital Markets Chief Economist John Lonski. John, good to see you. Now, I know you're not in the ratings division of Moody's and rating our debt, but do you think this Fitch action, the warning, is justified?
We'll have to see. You know, in the past, when we had government shutdowns, Moody's, I believe, was willing to maintain the AAA rating as long as the prompt repayment of outstanding government debt, the payment of interest, the servicing of government debt was not in danger. And as long as that remains the case, perhaps there will be no downgrade of the AAA rating.
All right, so when S&P did it many years back, they weren't doing it on the basis of a shutdown, but the kabuki theater around the threat of one and the back and forth and the games being played with the numbers, and they did cut the AAA rating at the time. Do you think that, ironically, it won't be a shutdown that does it, but just this finger-pointing and blaming going on the both parties count?
Gee, you know, I don't know if that's reason enough for a credit ratings downgrade because of political friction. I think you need something more than political friction. For instance, suppose we had the dollar exchange rate tanking, Treasury bond yields were soaring, markets were in disarray because of the government shutdown. Maybe then there might be some reason for a credit rating downgrade, but those circumstances still aren't being met. They're not occurring. And, you know, when we look at the long-term health of the U.S. credit rating, we do pay a lot of attention to the role of the U.S. dollar in the world economy, as well as the role of the Treasury bond market in the world economy. And for now, neither role has been threatened by the current government shutdown.
We must have a very generous grading system, though. I can distinctly remember when I was in high school, I got an A in chemistry. I had no idea what the heck I was doing in chemistry, and somehow I got an A. And either I had a very sympathetic professor, maybe he was just drunk, didn't realize it, but I kept saying there is no way I deserve this A. And I oftentimes think of the United States, with all the financial games we play, whether we deserve a AAA credit rating.
Well, you know, again, the U.S. dollar is still the world's primary currency.
No, you're right. You're right.
There's no getting away from that. And foreigners are willing to pour money into the U.S. Treasury bond market. I mean, what, 40 to 50% of U.S. Treasury debt is held by the rest of the world, people outside the United States. So we just simply don't see individuals running away from the U.S. dollar, running away from U.S. Treasury debt because they fear explosive growth by the federal deficit or debt.
Thank you, John, very much. By the way, I never argued with my professor for that A. I just said, well, this is a nice surprise. We'll see what happens. John Lonski, thank you very, very much.